Walgreens has been an iconic American company for over a century, proudly located at the corner of happy and healthy. However, recent news suggests that the company is now at the intersection of cutting costs and closing stores. Founded by Charles R. Walgreens Sr. in 1901, Walgreens began after he purchased the drugstore in Chicago where he worked as a pharmacist. By 1913, just 12 years after opening the first store, Walgreens had expanded to 4 locations on Chicago's South Side. The growth continued, and by 1919, there were 20 stores. By 1930, that number had skyrocketed to nearly 400, with annual sales reaching an impressive $4 million, a staggering amount for that time. Per the company's website, as of August 2020, approximately 78% of the U.S. population lived within 5 miles of a Walgreens or Duane Reade store. Duane Reade is a chain of pharmacy and convenience stores acquired by Walgreens in 2010. At its peak in 2015, Walgreens operated over 8,000 locations, filled 894 million prescriptions annually, and posted profits of $4.2 billion on revenues of $103 billion. It seemed nothing could slow the rise of this corporate titan. But in a stunning turn of events, Walgreens announced on March 7, 2025, that it had agreed to be acquired by private equity firm Sycamore Partners in a deal valued at approximately $10 billion. The transaction, which could reach up to $23.7 billion when including debt and future payouts, will take Walgreens private, ending its nearly century-long run as a publicly traded company. The acquisition comes on the heels of a dramatic decline for Walgreens. By 2024, the company posted a staggering $3 billion quarterly loss and saw its stock price crater by 80% over a 5-year period. Once valued at over $100 billion, Walgreens' market capitalization had fallen below $8 billion before the deal was announced. So what drove this iconic company to the brink of collapse? The answer lies in a perfect storm of internal missteps and external pressures. In this video, we'll take you inside Walgreens' astonishing fall from grace and explore 4 broad key factors that have contributed to this decline and how the Sycamore Partners acquisition could reshape the future of this American institution. Financial struggles and store closures. To understand the severity of Walgreens' decline, let's start by looking at some key financial metrics. In July 2019, Walgreens stock was trading at around $56 per share. Fast forward to mid-2024, and the stock had plummeted to just $11 per share, a staggering drop of approximately 80% in only 5 years. The low point came in the 4th quarter of fiscal 2024, when Walgreens reported a shocking $3 billion net loss. A significant portion of this loss stemmed from a massive $2.3 billion deferred tax asset charge related to opioid liabilities, as well as an impairment charge tied to the company's equity investment in China. While Walgreens did see some glimmers of hope, such as a 6.5% increase in U.S. pharmacy sales, it wasn't nearly enough to offset these major financial blows. Faced with this grim reality, Walgreens CEO Tim Wentworth admitted that less than 70% of the company's 8,700 U.S. stores were actually profitable. This led to the drastic decision to close 1,200 locations, representing nearly 14% of Walgreens' entire U.S. store footprint by 2027. That's a bitter pill to swallow for a company that had spent decades aggressively expanding across the country. It's clear these underperforming stores had become a major drag on Walgreens' overall financial health. However, critics argue that this store rationalization plan is more of a band-aid than a cure, and that Walgreens needs to invest in major technological and operational upgrades to truly get back on track. For most of its history, the core of Walgreens' business model has been its pharmacy services. Traditionally, this has been a reliable profit engine for the company. However, in recent years, Walgreens' pharmacy business has come under increasing pressure from multiple directions. Perhaps the biggest challenge has been the steady decline in prescription reimbursement rates from insurance companies and government payers. As these payers have sought to control rising drug costs, they have systematically ratcheted down the amount they pay pharmacies like Walgreens for filling prescriptions. Lower reimbursements mean slimmer margins on each prescription sold, directly impacting profitability. At the same time, Walgreens is facing intensifying competition from new entrants seeking to disrupt the traditional pharmacy model. One notable example is Mark Cuban's Cost Plus Drug Company, an online pharmacy that offers common generic drugs at steeply discounted prices. The rise of popular prescription discount programs like GoodRx has also made it easier for consumers to shop around for the lowest prices, further pressuring Walgreens' margins. Compounding these financial challenges are the changing expectations for pharmacists themselves. Increasingly, pharmacists are being called upon to serve as frontline health advisors, spending more time counseling patients, administering vaccines, and providing basic screening services. While these expanded roles provide a valuable service, they also take up more of pharmacists' time, reducing the volume of prescriptions they can fill and putting a drag on revenue. The pharmacy industry is also grappling with a growing labor crunch. Demand for pharmacists is far outstripping the supply of new graduates, driving up labor costs at a time when pharmacy profits are already under pressure. This shortage makes it difficult for Walgreens to fully staff its pharmacies while maintaining standards of customer service. Taken together, these factors have turned what was once Walgreens' greatest strength into a potential liability. With its core pharmacy business under assault from all sides, Walgreens has struggled to adapt to a changing competitive landscape. While the pharmacy pressures we just discussed are challenging enough on their own, they only tell part of the story behind Walgreens' decline. The company's retail operations, which include front-of-store sales of everything from candy bars to cosmetics, have also taken a major hit in recent years. One of the biggest blows came with the waning of the COVID-19 pandemic. During the height of the crisis in 2020 and 2021, Walgreens played a major role in the nationwide vaccination and testing effort. This drove significant foot traffic into stores, as millions of Americans streamed in for jabs and swabs. However, as the acute phase of the pandemic faded, so did this reliable source of retail revenue. In the third quarter of 2023 alone, Walgreens reported a 59% drop in net income compared to the previous year, largely due to declining COVID-related services. But even beyond the pandemic, Walgreens' retail business has struggled to adapt to rapidly changing consumer behaviors. Like many retailers, Walgreens has been grappling with the effects of high inflation, which has caused many consumers to tighten their belts and cut back on discretionary purchases. This has been especially challenging for Walgreens, given that many of the front-of-store products it sells are just the type of small indulgences that cash-strapped shoppers are likely to cut first. To make matters worse, Walgreens has also been plagued by a surge in organized retail theft, particularly in high-profile markets like San Francisco. This not only cuts directly into profits by shrinking inventories, but also drives up costs for additional security measures. Walgreens is also facing ferocious competition from the likes of Amazon and major grocery chains, many of which have been expanding aggressively into health and wellness products in recent years. As more consumers embrace e-commerce and one-stop-shop convenience, Walgreens' relatively narrow front-of-store assortment has struggled to compete. The net result of all these factors has been a steady erosion of Walgreens' retail performance. In an effort to diversify beyond its core retail pharmacy business, Walgreens made a big bet on expanding into primary care in recent years. The centerpiece of this strategy was a partnership with VillageMD to open hundreds of in-store primary care clinics across the country. Walgreens' leadership saw this as a way to capitalize on the company's vast retail footprint to bring more accessible and affordable healthcare to communities. However, this ambitious plan soon ran into major roadblocks. In early 2024, Walgreens announced that it would be closing over 150 of its VillageMD clinics and significantly scaling back its investment in the venture. This retreat represented a major blow to Walgreens' diversification strategy and a tacit admission that cracking the notoriously complex primary care market would be harder than expected. According to industry analysts, while the idea of expanding access to primary care services through retail clinics remains promising in theory, the actual execution has proven to be very difficult. Challenges include attracting enough patients to make the economics work, navigating complex insurance reimbursement structures, and finding the right balance between maximizing retail space for traditional sales and dedicating square footage to clinical services. The failure of the VillageMD experiment dealt a costly blow to Walgreens both financially and strategically. Not only did it vaporize a significant capital investment, but it also left the company without a clear alternative path to revenue growth outside of its troubled retail pharmacy business. The problems we've discussed so far, from reimbursement pressures to retail headwinds to the failed clinic expansion, would be daunting enough for Walgreens on their own. However, it's important to understand that they are unfolding against a backdrop of intense challenges for the entire U.S. healthcare system and economy. One major issue is the precarious financial state of many hospitals and health systems in the wake of the pandemic. According to the American Hospital Association, many facilities are operating on razor-thin margins or in the red, which in turn puts pressure on all the other players in the healthcare ecosystem, including pharmacies like Walgreens that depend on provider referrals and prescriptions. The entire healthcare sector is also struggling with a severe labor shortage that predates but was exacerbated by the pandemic. From frontline nurses to pharmacy technicians, healthcare workers are in high demand, and employers are having to pay higher wages to attract and retain talent. This puts even further pressure on already strained bottom lines. On the consumer side, inflation remains stubbornly high, forcing many Americans to make tough choices about how to allocate limited household budgets. Even as pandemic restrictions have eased, many consumers are still avoiding non-urgent medical care due to concerns about exposure or cost. This translates into fewer doctor visits, procedures, and prescription refills, all bad news for pharmacies like Walgreens. Then there are also the deep structural changes in consumer behavior and preferences that we alluded to earlier. The rapid growth of e-commerce, telehealth, and direct-to-consumer healthcare models represent an existential threat to Walgreens' traditional brick-and-mortar business model. While Walgreens is investing heavily in digital capabilities to try to keep pace, it remains an open question whether it can pivot quickly and effectively enough to fend off nimbler online competitors. The $10 billion acquisition by Sycamore Partners, taking Walgreens private after nearly a century, underscores the severity of its challenges. While private ownership provides flexibility to streamline operations and adapt, Walgreens must still confront the fundamental pressures driving its decline. However, this acquisition also presents an opportunity for reinvention. With the right strategy, Walgreens could emerge leaner, more agile, and better positioned to meet the changing needs of patients and customers. Ultimately, Walgreens' fate will be a bellwether for the pharmacy industry. Its ability to navigate this transition under private ownership could light the path forward for other struggling chains. The coming years will be critical in determining the future of Walgreens and its competitors in today's unforgiving business landscape. Thanks for watching.